Ever wondered how big investors and hedge funds pick winning stocks? Here's the surprising truth. They don't rely on secret tricks. They focus on a few key metrics, and the best part, you can use the same ones, even as a beginner. Let's break it down in simple terms. Institutional investors manage billions of dollars, but their core strategy is actually simple. They look for strong, growing, and stable businesses, and today, I'll show you the exact metrics they use with real examples. First, revenue growth. This tells you how fast a company is growing. Think of it like this: if a business is making more money every year, that's a good sign it's expanding. For example, companies like Amazon grew massively because their revenue kept increasing year after year. So what to look for? Look for consistent growth over 3 to 5 years, not just one lucky year. Next, earnings and EPS. Earnings per share. Revenue is great, but profits matter more. A company could be making billions, but if it's not profitable, that's a problem. For example, Apple doesn't just make money, it makes huge profits consistently. Simple rule: rising EPS equals strong company, falling EPS equals warning sign. Now, PE ratio, price to earnings. This tells you if a stock is expensive or cheap. For example, high PE equals investors expect high growth. Low PE equals might be undervalued or risky. Don't look at PE alone, always compare it with similar companies. Next, free cash flow FCF. This is the actual cash a company has left after expenses. Why does this matter? Because cash is real. Profits can sometimes be manipulated. Big investors love companies with strong cash flow. Now let's talk about debt. Companies often borrow money, but too much debt is dangerous. For example, if the economy slows down, highly indebted companies can struggle or even collapse. Simple rule: lower debt equals safer investment. Next, return on equity, ROE. This tells you how efficiently a company uses investor money. Good benchmark is if ROE is 15% or higher. Think of it like this: if you invest $100, how well does the company grow it? Now, one of the most important factors, competitive advantage, or commonly called moat. This means, how hard is it for competitors to beat this company? For example, Coca-Cola. People know the brand worldwide, it's hard to replace. We can say that strong brands results in being long-term winners. Finally, economic factors, like interest rates or inflation, also contributes to changes in stock prices. For example, when rates rise by institutions like the Federal Reserve, stocks can fall. So here's the simple checklist: look for companies with growing revenue, rising profits, strong cash flow, low debt, competitive advantage. That's exactly what big investors do. If you found this helpful, follow and subscribe for more simple investing tips. And remember, great investing is about consistency, not complexity.